Good evening, everyone. Welcome to the Loan Officer Training Series with the Mortgage Calculator. Tonight, we're going to talk about how to structure loans with excluded liabilities. Give us just a moment here to go live on all the different platforms. We got the chat up on the screen there. Go ahead and drop a comment there in the chat as you tune in. We appreciate it. Great topic here for tonight. Definitely some functional things we've been talking about this week here. Some very important basics to do. All right, looks like we are live on all the platforms, so we'll go ahead and get it started here. What we'll do is we will take the chat off the screen for now, but go ahead and drop your comments there in the chat. You can also drop any questions you have in the chat as we go through the presentation here today. So, welcome everyone. My name is Kyle Hershey. I'm the COO of the Mortgage Calculator, joined here by our president, Nick Hershey, and our sales manager, Jose Gonzalez. We are a lender that specializes in non-QM loans. And what we do every Tuesday, Wednesday, and Thursday evening on this show at 7 p.m. Eastern is go through a different in-depth loan officer training topic. Tonight, we're going to be talking about how to structure loans with excluded liabilities. So I'll go ahead and turn it over to Jose to get into the presentation. Again, if you have any questions, you can drop them there in the chat. So go ahead, Jose.
All right, welcome to everybody to tonight's training, adding some more value here out there on all of the how to structure loan series that we're doing. And since we are getting more agency and full doc type loans, definitely we are having to split hairs in some cases and to get to the promised land. And our excluded liabilities are knowing how to navigate those waters when you may be considering excluding liabilities. And by this, we are not just talking about current liabilities like payments due, but you could also be talking about collections and charge offs and how those come into play in being able to exclude them rather than pay those off. So two things going on here now: DTI and or cash to close on some type of exclusion that you may have to do. So let's jump right into it. So what exactly do we mean by an excluded liability? Because if you search that phrase excluded liability, you're not exactly necessarily going to get what we're talking about. We've sort of combined it to mean something, an excluded liability. It is essentially a debt service payment or collection judgment, also, but in most cases, we're talking about a debt service payment that is not being considered in the total DTI due to less than 10 payments due on an installment account. Notice I put their installment account, not a lease. Uh, Definitely that's not going to be applicable to a revolving account, which doesn't have an end date. It could be a liability monthly payment due that is being paid by a co borrower of the asset financed by the installment account for at least the last 12 months. So if you're able to document the payment by a co-signer on that asset. So if it's a car, it can't just be my car being paid by my brother, and my brother is not a co-borrower on that loan. It would have to be mine and my brother's car, or whoever it may be. It doesn't have to be a family member. Just using that example, being paid for by my brother or whoever's making, the other co-signer on the loan, co-borrower on the loan, and documenting at least the last 12 months. If you have less than 12 months that have been paid because it hasn't been open for 12 months, that's going to be a case by case basis. Maybe you had a similar setup on the previous vehicle and you can show the track record, like this is how we do it. Or, you're really going to be up to the mercy of the underwriter there because all the guidelines call for 12 months to offset that payment when it's being paid by a co-borrower. The same scenario, if the monthly payment due is being paid by the borrower's business for at least the last 12 months, then That's another way in which we can do it. I've had this scenario where it was less than 12 months, it was only 10 months, but the borrower had done that on the previous vehicle. So we had 12 months payments, two for the previous one that got, turned in, traded in, and then the new one that was bought. And then we had the last 12 months. But remember, these were not leases, these were installment loans on a vehicle purchase. And obviously, it has to be the borrower's business, not another business that the borrower doesn't own, because then we fall back into the same scenario that is being paid by somebody else who doesn't have a vested interest in the property as a co-borrower, liable on the note for that asset. That's really what it boils down to. And another excluded liability is when you have a revolving account and a credit card that is being paid down, or an installment account that is being paid off at or prior to closing. Now, be aware that if this is the option chosen, the cash to close or the needed funds for closing doesn't have to be cash. It's actually not cash, as you all know. We just use that phrase. But the cash to close will increase according to the amount for that revolving or installment account that is stated that's going to be paid at closing. If it's paid before closing, now if you click that box that says, will be paid, then it's going to increase the cash to close. If you're just going to click exclude, then if you're running AUS, it's going to tell you, hey, you excluded this liability, give me the proof. And then you're going to give the proof, hey, look, this was already paid off. Or if it's non-QM and it's not AUS, underwriter's going to ask for that. But in any case, just be aware that the being paid down or paid off option, if it happens at closing, you're going to have to document that extra cash to close. If it also happens during the loan process, you're going to have to show where that money came from, right? It just can't be like, hey, I paid it off. Okay, show us how it got paid off. They want to know that you paid it off, the borrower, that is not paid off with borrowed funds, or is it actually a gift, right? Hey, Jane Doe paid it off. My sister Jane paid it off. Okay, then we're going to consider that a gift. There's a gift letter. The payment of the asset is the gift. I mean, that gets into some gray areas there. And then also I did mention, which we're going to touch on later in the presentation, where we're excluding a judgment or a collection account due to different reasons, right? It could be that AUS told you, automated underwriting, DU or LP told you, hey, we underwrote this account. We reviewed it. We know the borrower has all these collection accounts. The collection accounts do not need to be paid. Beautiful. Now, it may tell you something else to do with those collection accounts, like add 5% to the balance or not, depending on the guidelines. But just be aware that doesn't get you by surprise. But on agency loans, it's going to be AUS is going to determine that. I've had that happen on a primary purchase. $50,000 in charge-offs, 80% LTV. Borrower didn't have to pay it off, right? You see that also on FHA loans, right? Depending on the LTV, it may say, hey, these collections or charge-offs can remain unpaid, but it may also tell you about adding a 5% of the balance to the payment. So just read your findings and see what they state so that your LTV is going to be correct, and so that your borrower can benefit from all of these situations to exclude these liabilities, but that the DTI at the end is correct, right? So we covered in general, right? Then how do you exclude the liability payment in the LOS? Now we use Encompass, so these two screenshots here are from Encompass. But the first thing you want to do, and if you use other LOSs, it's going to be similar to this, but the first thing you want to do, regardless of the LOS it uses, you want to ensure that the account type can actually be excluded per the guidelines of the program option selected. So it's FHA loan. Make sure you look at the FHA handbook. Fannie Mae, look at the Fannie Mae selling guide. Freddie Mac, look at the Freddie Mac selling guide. USDA, look at the USDA guidelines. VA, look at the VA guidelines. Because they're all different, right? Non QM, especially now, you look at the non QM guideline for the option that you're selecting because those are definitely different. But even on the agency side, conventional is going to allow you doing things a certain way that FHA is going to treat it another way, USD another way, and VA another way. And you just have to be aware. So make sure that you can actually exclude that. For example, this is the most common one that gets people. You cannot exclude a lease with less than 10 payments unless the borrower owns another vehicle, as the assumption by underwriting is that the borrower will need to lease another replacement vehicle once the lease on the one they have now expires and they don't decide to buy it and keep it. Then they're going to usually lease another one. It's going to be really difficult for the borrower to provide an LOE. I'm not going to lease any more cars. I'm just going to ride my bike and all that kind of stuff. I mean, that's probably not going to happen. If the lease is still active, they're not going to let you exclude it. Now, if there is no lease payment in the inception of the application, there's nothing to exclude. They can't say, "Oh, we're going to add a lease payment in here because we know your borrower is not going to walk everywhere or ride their bike." They can't say that, but they will not exclude an existing lease. The assumption is they're going to get another lease. So that's one of the examples of accounts that you can't exclude. Now, what you want to do on the mechanics of how to do this exclusion, right, is first you go to the Show All VOL tab that I have there highlighted in yellow. That's in section 2C of the LOS. You're going to click on that. And when you click on that, it opens up the box with all of your liabilities. And some people, it's quite a few liabilities, right? But it opens up the box with all your liabilities. And then you're just going to scroll down till you find the liability in question. You're going to click on it. And then that's going to open the liability itself, the detail below. And then it's going to look something like what you see right there, right? Then you see I have highlighted there that this is an installment account. The account is in the name of John Doe. This is the account number. The months left, I'm sorry you can't see it over here, but it says 9 months left there. So we know we can exclude that one because there's only 9 months left. So we're going to click right here where it says exclude from IRLA liabilities total. Once you do that, you'll see the DTI drop on your file. You go to your file summary screen, wherever you go on your LOS to look at the DTI, you'll see it drop, right? Now, if you click will be paid off, which is above here, I'm sorry, I didn't highlight that one in yellow, then it will also, you don't have to also click exclude from liabilities. I mean, you can if you want to, but once you click will be paid off, the system knows to exclude it. And then, like I mentioned again, it's going to increase your cash to close because will be paid off. It's assuming it's going to be paid off at closing. If it's going to be paid off before closing during the loan process, then don't click will be paid off. Just click exclude from IRLA liabilities total. In which case, then if it's an agency loan, AUS is going to ask you for documentation as one of the conditions. Hey, we see you excluded the liability, the installment loan from Acme Credit, I think is who that is. So please provide documentation to support the exclusion, right? So if I'm excluding it for a number of various reasons, like the borrower says, hey, Jose, I already paid that off, it should be showing zero balance and no payment, then you would provide the proof of the payment, a credit supplement where they updated the balance to zero. Uh, if it's being excluded because of one of the many other reasons that we mentioned, which we're going to get into now shortly in the couple next slides, then you would provide the documentation for the reason chosen for the exclusion, right? So a number of different ways to structure this in that manner, but just note exclude, you're going to be asked for documentation to exclude, will be paid off. It's going to be paid off at closing, and you're going to have to show the funds, and then the title company pays it off at closing, and that's how they know that it got paid off because it's going to appear in the HUD. Acme got paid off for their $100,000, and here it is on the closing statement because we have an invoice to pay off, or the which shows the account balance. Typically, we would, if you're going to pay it off at closing, they're going to ask you for a payoff, right? Or if it's a revolving account, current statement showing what has to be paid down to zero, so that then you can either be zero payment on a conventional or $10 if it's FHA, which I actually got a little bit ahead of myself because that's on the next slide. But before I leave this slide, I want to make it clear on everyone the difference between exclude and will be paid off. Big difference there. So excluding liabilities on agency loans, right? It really depends here on what is the reason for the exclusion. That's key here, and that's what's going to determine the documentation that you need to provide. So if the exclusion reason is less than 10 payments are due, right? That's pretty easy one. I showed you there in the previous slide where that one was highlighted as an installment account. It can be an installment or a mortgage account. It just cannot be a lease. Now, one very important point there that I have is that the borrower cannot pay down the balance to meet the 10-month requirement. It has to be a naturally occurring organic situation, Like if you owe 11 months now and, next month you're going to owe 10 months, I think they will let you pay that month now. It's just a couple of weeks. It's normal to pay a couple of weeks ahead of the due date. But they're not going to let you pay if you're on 13 months to get the 10. They're not going to let you pay month number 13, month number 12, and month number 11 now so that you could get the 10 or less next month. That's just not going to happen unless you can show a pattern of having paid 3 months every month or something of the like. I usually do this. Look at all these other months where I've done that. Then that's a different story. But if there's no track record of doing that, then you can absolutely not do that. Pay down a bulk amount of months just to do that. I mean, it's asked all the time. Now, another exclusion reason is pay down the credit card debt to zero. Right? Now, you don't always have to pay it to zero because, team, remember now we're talking credit scores now different. But if you're looking at just a payment, right? If you're looking at just a payment being affected and not credit score, now this is not a rescore, then if you pay down to zero on an FHA loan, for example, the underwriter will calculate $10 as the minimum payment. Regardless, on a conventional loan, it will be zero. Zero if it's a zero balance, and then you do a credit supplement to show the new statement showing the zero balance. Now, beware that you're not needing to lower your DTI because you need to get an approved eligible. Right, I just throw this in there as additional learning for tonight. If you're looking to lower the DTI on a loan because you need to get the approved eligible, a credit supplement at the credit reporting level isn't going to work. It has to be a rapid rescore at the bureau level so that automated underwriting picks up the new payments and the new DTI, right? But that's if you need that to qualify. If you got your approved eligible and all you're doing is excluding, then a simple credit supplement where you request it after the borrower confirms, oh yeah, Jose, I paid the balance down. They can call now and verify. Then you order the credit supplement, or your processor orders a credit supplement from the credit reporting agency who you use. They will call up the creditor, verify the balance, verify the payment, and your credit supplement is completed. And then if the exclusion reason is paid by someone else other than the borrower, then again, ensure it is being paid by that someone else from a non-borrower account, right? I mean, if they share the account And it's like, well, yeah, but he's writing the check or she's writing the check. Yeah, but they share the account. That doesn't work. That's a no go. Ensure that the person paying it is actually a co-borrower on the loan. I touched on this earlier. If it's just, you know, so Mr. X paying for it for Mr. Y, right? And Mr. X is not a co-signer or co-borrower on that asset, on that loan. He's just, it was a straw purchase, right? Where somebody did it for somebody else who just has horrible credit, so horrible that they couldn't even be on the application, or they didn't want to be for some other nefarious reason. Then if that person doesn't have a vested interest in the loan and the note as a signer, as a co-signer, then it doesn't matter that they're paying for it for the last however many 30 months. It's still going to count against the borrower. Need to document payment of at least the last 12 months is another critical component. Now, I did mention um, that I had one where that he had it only for 10 months, right? But and it was being paid by the business. But we were able to show the previous track record that he did it the same way through the business for the previous vehicle that they owned. So that one was accepted. But that was pretty easy to get that one approved. But if it's less than 10 months, and they've only been there 10 months, and that's why you only have 10 months, and yeah, they may or they may not approve it. It really depends on the other compensating factors in the file if they're going to give you the exception on that scenario, because it is 12 months. It doesn't say 12 months unless they've owned it less than 12 months, and then we'll go with however many months they owned it. And if it's being paid, if the exclusion reason being paid by someone else is because it's being paid by the business, then we need all 12 months from the business account. You can't have, like, hey, this month I paid it with my personal account for 2 months, and because I ran out of checks, or you were too lazy to go onto online and do it online, then you're probably going to be out of gas on that one, because your business is not you. It's a separate account, right? It's the business account, but you are you. So make sure it's all 12 months from the business. It could be separate business accounts of the same borrower if it's their business, but not somebody else's business. Again, that's not the borrower on that asset. And real importantly, there on the bottom there, when I mentioned about excluding collections and judgments, very important that you keep an eye on the automated underwriting findings that may require adding 5% of the balance as the monthly payment on excluded collections and judgments. If they're going to ask it, it's in there. So make sure you account for it, or else, if it's a $50,000 account with whatever, $5,000, could be a big payment. 50,000. There could be 2,500 as a monthly payment, and that will really kill a lot of people's DTIs. Now, last but not least here, if excluding liabilities on non-QM loans. Now, the interesting part about non-QM loans is very similar. Non-QM a lot of times copies Fannie Mae guidelines, so you'll see a lot of similarities there, except the one about paying the credit card down to zero. This is not an FHA loan, so you don't have to worry about that. But here, being manual underwriting, it's the guidelines that determine what we do, and not automated underwriting, right? There is no DU or LP kicking up like, hey, we're letting your borrower not pay off these 50,000 in collections because it was a strong deal, low LTV, high credit, maybe they have reserves, assets, all that kind of stuff. Automated underwriting algorithm looks at all of that stuff and then decides yes or no, pay, no pay, consider 5% or not, all that kind of good stuff. On non-QM, it's all about the guidelines. So we, just like you can pick a 1-year program on Full Doc instead of a 2-year program, if that matters for your self-employed borrower, that can be really important. Um, Another thing is judgments and collections. We have options in non-QM where you simply select the program that allows you to do that. So if you know you have that need where you have a borrower that has 50,000, 100,000 in judgments and collections, and they told you already, Jose, reason I'm coming to you is because I know the mortgage calculator has a lot of outside the box options, and I have $100,000 in collections, charge offs. I don't want to pay them off. Those really weren't mine. I co-signed for some credit cards for my brother. He racked them up at the casino. Next thing you know, he's not paying them, and I'm on the hook. And all the time, I thought I was helping him out so he could eat. So I'm not going to pay those off, right? So what are you going to do? Well, at the mortgage calculator, luckily we do have those solutions where you just select the product option that lets you not have the borrower pay those off as long as certain requirements are met. There's a bunch of different ones, so I can't get into all of them right now. But the main one is going to be that the borrower has enough assets in reserves to cover the amounts, and then nothing has to be paid. And then in some cases, they may require a 5% of the balance as the monthly payment of doing so. So be aware of that. So, there is a trade off. But if you're doing a bank statement loan with $30,000 a month income as your income, then DTI is not an issue. It's just the borrower telling you there's no way I'm going to pay $100,000 off on those credit cards that I had no benefit, not $1. And I could totally understand if somebody would be in that situation. I wouldn't want to pay that debt that I didn't benefit from just because I was helping somebody out. And if I was given that solution, I would jump on it. And we provide those solutions all day long. That's why I have it up there. Number one, a nice exclusion reason, because one of the outside the box reasons why we do get a lot of loans is when we provide these solutions to borrowers. And this is a big one. This is one that you got to rely on automated underwriting to tell you if you can do that or not. On an agency loan versus non-QM, just pick the right guideline, make sure you're within the matrix requirements for LTV, credit score, all that good stuff. And I mean, the rest should be a no-brainer. Now you see the other exclusion reasons are all going to be the same. If it's less than 10 payments due, then make sure that it's installment account or mortgage, not a lease. You're gonna pay down the balance to 10 months to meet the requirement. If you pay it down to zero, the payment to be considered will be zero, not $10 like FHA. And if it's being paid by someone else, again, all the same reasons are applicable. Um, don't if hopefully you're not sharing the account with that person, and hopefully they're a co-borrower on the loan as well for that account, for that asset. And make sure you're documenting 12 months worth of payments if it's from their personal account or from the borrower's business account. So hopefully this has added some clarity to everyone who is encountering this or may have seen this now and said, oh my God, I got a deal that I can save now because I didn't know that I could look for an option that allowed my borrower to not have to pay off those 50,000, 60,000, $100,000 in collections and charge-offs. I mean, I just had one of our MLOs today that got a loan application from one of the topics we just did this week, the how to structure a loan with a seller held second. And she actually got a commercial deal with 60% LTV financing on the first, 30% LTV from the second, and gonna get in on the deal on a very unique property type. So congrats out there to the MLOs taking these lessons into consideration and making loans out of it.
All right. Thank you, Jose. I don't see any questions. So I think we can go ahead and wrap it up then. I do appreciate everybody tuning in. Remember, every Tuesday, Wednesday, and Thursday evening at 7 p.m. Eastern, we do one of these loan officer training topics. So we will see you all next week on Tuesday, 7 p.m. Eastern, for the next episode of the Loan Officer